All right, welcome back to the Midweek Update. Today is Thursday, February 3rd. My name is Patrick Dunawilla. I am the editor of the Chart Report. Joining me today is Steve Straza of All Star Charts. Steve, how are you?
Good. How's it going?
It's going good. It's going good. All right, so there's a lot to cover, so let's just get right into it. We got a couple stocks we like. I don't want to call them stocks picks because, this is for educational purposes only, but we got a couple stocks we like at the end there, so stay with us. So first things first, let's take a look at the S&P 500. We close higher every single day this week, except for today. We gapped lower. It's kind of a nasty reversal. This morning, Steve, I was talking to you. I was like, did we have an island reversal today? What do you think? What's your call on that? I have it zoomed in here for us.
Yeah.
So we have a little closer look at the last 3 days.
I mean, it was close, right? Technically, an island reversal would have an upside gap and then downside gap on Wednesday and today, Tuesday and today. So it's close. It's all the same thing. You don't want to be too strict with your patterns, right? Because it's just, we're trying to analyze supply and demand, what happens that day, how buyers and sellers are kind of facing off. So, if it's close enough, then it's the same things really apply, right? So this is, you're seeing basically price had a nice little automatic reaction bouncing off the lows. We had a nice rally this week, and then it just got wiped out with some really strong selling action today. A lot of the indexes closed close to the lows. You never like to see that. But again, let's see what tomorrow brings, because this is really the first time that we've seen some solid follow through from the major averages since, for this year, right?
Yeah, and we're getting that slew of big earnings reports from all the big ones. So, that's kind of causing a lot of volatility in stocks this week. So, let's focus on some of the things going on outside the stock market. And I think the biggest story this week there is the breakout in German yields. The 10-year, the German 10-year yields went positive for the first time in over 2 years, which is pretty crazy to think that it went positive, right? I think it was JC saying that it's not every day that you see resistance at zero, but that's the case here for the 10-year. So Steve, why do we care about the German 10-year yield? Where does it fit into the picture here?
Well, it's supporting evidence, right? We're paying more attention, obviously, to what's going on U.S. yield market and U.S. bond market. But global yields, especially developed market yields, they tend to trend together. So basically, you could take a weight of the evidence approach. A lot of these charts of the government benchmark yields, if you look across Europe or even in the US, they're just these nice, rounding bottoms, big bases, and they're all breaking out to multi-year highs in synchrony. This week, last week, big moves from the German 10. Japanese 10-year yield is at its highest level in 6 years. Seeing similar action from the UK, Spain, Italy, France, across the board. So I think that bodes really well and supports these new highs in the US 10-year and suggests we'll probably see further upside if these big bases are really resolving higher and doing so in a decisive way, which it looks like they are. You would think the US 10-year follows, right?
Yeah, so basically we're finally getting that move in international yields that's confirming what we're seeing in the move higher in yields here in the US, right? Yeah. And we didn't have that last year. And I think you've been bringing up that point a lot lately. And I think it's a really good point. Last year we saw yields breaking out and moving higher, but we didn't have that confirmation from global yields. Is that correct?
No, they were still kind of in the base building process. Like if you go back and look at the German 10-year yield chart, very similar to what happened in the US with the US 10-year, it couldn't break out of that base in, March or April of last year, failed just like the US 10-year. But now this time around, you're seeing them both go. And it's not just these two. If you look across the developed world, you're going to see something really similar.
Yeah, so it's basically telling you that this move in US rates is for real, and it's probably going to stick, right? We're probably heading higher.
Yeah. If you see these bases start failing, then it's a different story, right? But if all these base breakouts stick, sure. And then what do you want to be buying? This chart does a good job of illustrating that, right?
Right. Values continued to work. We saw it come out strong right out of the gate in the new year, but it really hasn't stopped. I mean, we saw a little bit of mean reversion, but the train's kind of kept headed north.
Right.
What do you think?
And you made a good point too. It's not just small cap value, right? Large cap value is actually performing much better. but this chart does a really good job of showing how these factors, the relative ratio of these factors moves with the 10-year yield. Correlation couldn't be tighter. So,
Yeah.
And I think even in the small cap space, right? If you want to look at small cap, sure, they're the weakest groups. I would say you still want to focus on, up the cap scale, the large and megas. Even in the groups that are working right now, it's the big guys, it's Chevron, Conoco, within energy, the big banks and financial institutions are working. But if you look at the Russell indexes, IWM, which is the Russell 2000, broke down, kind of completed that top. IWO, which is Russell 2000 growth, did the same thing, but Russell value is still kind of holding that range. IWN is the ETF we use to look at that.
Yeah. So basically you want to continue erring on the side of value, right? And for the people who don't know at home, what is value to you? What are the value sectors of the S&P 500?
Like right now, energy and financials are really the ones that come to mind because they've been the two strongest. But, materials, industrials also have heavy value and really heavy cyclical exposure too, which is extra important in this environment with commodities trending so well.
Yeah. I real quick, I want to talk about real estate as it relates to the whole growth value thing, because, I don't really think of real estate as a growth sector. It's not grouped in there with some of the high price tech and stuff like that, but it's getting thrown out along there with some of the high price growth stocks, right?
I think it's more of an interest rate story because
Right,
real estate
back to rates moving higher.
Yeah, it's more of a bond proxy sector. I would group it more with utilities and staples. Higher rates is not usually a good thing for real estate companies, right? If you think about the way they do business, obviously they're borrowing and purchasing real estate, a lot of these groups, so a lot of these stocks. So I think they're probably coming under pressure, not so much because their growth, but because of they're
rate sensitive.
Yeah, they're very rate sensitive. Yeah.
I see. Well, so yeah, let's talk about energy, the best performing sector last year and by far this year too. It's up 23% in the 5 weeks so far this year, 4 or 5 weeks.
It's kicking off the new year with a bang.
Right. Sure. The only other sector that's positive, you have staples that are basically flat, but financials are up a negligible amount, more or less, but 1.5%. But yeah, 23% gain. So what do you think? Is it extended here? This is a very long-term chart. It's breaking out of a 7-year downtrend. Would you call it extended?
Sure. Right. By traditional measures of momentum, it's pretty overbought, right? It does look like it's extended to the upside, but I would go to the next chart. When energy stocks go, they trend like commodities, they really go. So if you look last year, we had uninterrupted rallies. So 7 straight up weeks, 50% gain off the COVID lows, right? 6 straight weeks, starting in the fall of 2020, 43%, another 6-week rally, early 21, up 36%, or up 26% so far, since we broke out most recently. So I would be careful with that. I don't think you want to get too cute because this is a massive structural bearish to bullish trend reversal, right? When you look at this giant base and XLE or any of the energy indexes. So I don't think you want to be too tactical, right? Allow for some backing and filling, give your stops some room with these stocks, and you'll probably be in good shape looking out quarters from now.
All right. I got one for you though. Our buddy Arun Chopra, he pointed out that the trend in energy is so strong that only one man could stop it. And that man, of course, is Jim Cramer. And, I don't want to pick on him, but you got to admit the guy has been bearish on oil since it was negative all the way up to 90 a barrel here. And he finally threw in the towel and got on the bullish train. What do you think?
I don't pay much attention to it. I don't know what he said. I thought he was like morally opposed to buying oil and gas stocks. I think he's an ESG guy. That's fine. I think he's getting this one right, probably. I think this is really the start of a new bull cycle for energy stocks, energy commodities. This thing probably goes on for a while. So,
yeah. So you wouldn't be fading him?
I would not be fading Cramer here, no.
Interesting. So you brought one of your favorite stocks along. What is your favorite stock within the energy sector right now?
I like ConocoPhillips a lot. I like Canadian Natural Resources a lot. But Chevron's just such an easy one. It's a big name, a lot of liquidity there. You could put this trade on so many different ways. We just put an option trade on at All-Star Charts, but this is just a massive base breakout back above the 2014, 2018 all-time highs. I mean, you could define your risk right there. Doesn't get much cleaner. And like I said, this is one of the highest quality names in the sector. So what more could you ask for?
Yeah. What are some of the levels you're watching on that one?
It's those former highs. You want to define your risk right at those former highs. Like I said, with this kind of stuff, you could give it some room to back and fill. Like with our options trade, I think we're giving it to 110. If we're back below 110, close to 100, a lot of the things that we're probably seeing now and saying are going to happen, like, oil keep rallying, commodities will keep rallying, energy's in a new bull market. That stuff's probably not true if Chevron's back around $100 or lower.
I love it. I mean, that's a great looking chart. I brought one more for you. I want to get your thoughts on it. Got Raytheon. It kind of fits with that whole value theme.
Yeah.
What do you think? I know it's got technologies in the name, but it's not a tech stock. That's for sure.
Yeah, it's aerospace and defense stock. They've been a pretty weak group, considering you would expect them to be doing better in this, value tape. But
yeah, I mean, it's just now reclaiming the 2000 highs. I was surprised to see that.
I mean, listen, whenever you have such a clean chart or clean breakout like this, it's really easy because you know where you're wrong. So, buying stocks that look like this all day.
Yeah. Awesome. Well, Steve, thank you again for joining me, and I look forward to talking with you next week.
Talk to you soon, buddy.
All right. Take care.